Well, from rising oil prices to the prospect of a global recession, money market interest rates in recent days have soared yet again, leading to bond prices and gilt prices around the world collapsing with the fear of rising inflation. Now, that adds pressure to central banks, including our own Reserve Bank, to keep on raising interest rates. So let's bring in here Gerard Burg, Senior Economist International for the National Australia Bank. Gerard, many thanks for your time. This all stems from the United Kingdom raising taxes and then the Bank of England buying back bonds. Just explain why that spooked the global market so much.
Well, we're at a point in the global cycle where central banks are really focused on pushing down inflation. And the mini budget that was unveiled by the Truss government was essentially quite stimulatory, really counter to what any of the expectations of financial markets were anticipating. So that really saw the impact on UK bond markets, pushing down the prices. And we saw the Bank of England forced to kind of step in and buy back bonds, given the fears that this could really negatively impact pension funds in the UK. So, we see this really as a short-term measure, bringing things back under control.
OK, so what you're effectively saying is, on one hand, you've got central banks like the Bank of England, like the Australian Reserve Bank, that are raising interest rates to try and cool down the economy. But on the other hand, the politicians are getting a bit freaked out by the prospect of the hurt of a recession. So they're starting to stimulate their economies. This, of course, is one of the worries for politicians, that the central banks simply go too hard, too fast, and as a result, tip their economies into recession.
And we see that as a very real risk at the moment. Indeed, we see most major advanced economies recording little to no growth in 2023. We are forecasting a recession in the United States, for example, and a significant risk in the Eurozone and the UK as well. But right now, it seems that central banks are far more focused on inflation than overall economic activity. They're competing forces, and central banks are really keen to slay the inflation dragon right now.
OK, but then there's contrary evidence, such as, say, for example, labour shortages right around the world. They keep on going. Unemployment rates are very low, including here in Australia, but in the United States. Even you see retail sales. People, while they've got jobs, seem to be absorbing it. But then that adds to the argument, as I understand it, for interest rates to go even higher because the consumers really aren't changing their behaviour.
Yeah, we've got to remember that monetary policy is a very blunt tool, and it can take 6 to 9 months before you actually see the impact of these changes to really flow through to the economy. There's a real risk, I suppose, of a monetary policy mistake by major central banks, that they push rates too high and drive economies into a much more severe recession than necessary to bring inflation back under control. So many of the concerns really sit on the supply side as well. I mean, we've seen obviously the impact of COVID-19 flowing through into closures in China. We've seen supply chains disrupted, and as you noted, the labour market disruptions. All of these factors have contributed, and really interest rates will do nothing to resolve them.
So is this also one of the reasons and explanations as to why most currencies in the world right now are relatively low against the US dollar? Because the money is piling into the US dollar, effectively trying to chase a safe haven, but also trying to chase really the rising interest rates in the United States.
Yeah, indeed. I mean, the Federal Reserve has been one of the most aggressive in terms of raising rates. We've seen US bonds rise very rapidly when compared with a lot of the other markets. And, it's a problem for a wide range of economies. Currencies are weakening, and we're seeing capital flight out of a large number of emerging markets into advanced economies, primarily the United States as well. So there's a lot of money that is looking for yield, and right now it seems to be both looking for yield and safety in the US.
And one of the real testers, as I understand it, is that very long-term bond rate, the 30-year bond rate it might be. And when that gets above 4, as it has in the UK in recent days, that really is a bit of a telltale in advanced economies. Australia's around 3.9% at the moment. That they are in some sort of strife long-term in terms of their economic activity.
Yeah, well, when you factor the long-term investments in things like infrastructure and those sort of investments that governments are looking to make, adding the cost to those is a problem longer term. And certainly a lot of international organisations look at that long-term rate as a sign of how stable the financial position of countries are. And the red flags have been rising in the UK as a result of that.
I'll tell you what, it's good to have you in the program today. Gerard Burg is the Senior Economist International for the National Australia Bank, and I appreciate your time.